Everyone who told you gold was a bubble just got louder this week. And I need you to understand something before you listen to a single word they say. The people celebrating this crash on financial television are the same people who told you gold was overpriced at $3,000. They said the same thing at $4,000. They are saying it again right now at $4,600. And every single time they said it, the people who ignored them and held their position came out ahead. I am not here to tell you what you want to hear. I am here to tell you what the data actually says. And right now the data is telling me something I have not seen in years. It is telling me that one of the most significant buying opportunities in the precious metals market of the last decade just opened up quietly while most retail investors were busy panicking. Gold dropped 18% from its all-time high of $5,589 in January to below $4,600 this week. 18%. That number sounds terrifying if you do not understand what drives gold and why it moves the way it does. But if you do understand it, that number does not look like a disaster. It looks like a door that just opened. And doors like this do not stay open for long. Subscribe to this channel right now, because what I am about to walk you through is the exact framework that institutional investors use to separate temporary corrections from structural trend reversals. This is the kind of analysis that hedge fund clients pay thousands of dollars a month to access. I am giving it to you right now for free. One click. Do it before we go further, because what comes next is going to fundamentally change how you think about what just happened to gold and what happens next. Let me give you the context that the financial media has completely failed to provide, because without context, a number is just noise. Gold hit an all-time high of $5,589 per ounce on January 28th of this year. That peak came after an extraordinary run. Gold gained approximately 65% through 2025 alone. It crossed $3,000 for the first time during the April tariff shock. It crossed $4,000 during the U.S. government shutdown crisis. And it kept going because the structural forces driving it, de-dollarization, central bank accumulation, geopolitical instability, and real questions about U.S. fiscal sustainability, did not go away. They intensified. Then three things happened simultaneously in late February and March that created what technical analysts call a perfect storm of temporary selling pressure. The Federal Reserve turned more hawkish than the market expected, holding rates steady and signaling that cuts were not imminent. The Middle East conflict, specifically the ongoing situation in the Strait of Hormuz and the Iranian nuclear standoff, began stoking inflation fears rather than flight to safety flows. And the dollar, which had been weakening, won a short-term tug-of-war for global capital. Those three forces combined to produce the sharpest gold correction in years. 7 consecutive sessions of selling, an 18% decline in less than 2 months, and a wall of financial media commentary telling you that the gold bull market is over. Here is what they are not telling you. J.P. Morgan has not moved its year-end 2026 price target. That target is $6,300 per ounce. Deutsche Bank stands behind $6,000. Neither institution, with hundreds of analysts and billions of dollars of research behind them, has changed their structural view of gold based on this correction. They are calling it exactly what it is, a tactical pullback inside a structural bull market. And if they are right, the person buying gold at $4,600 today is buying it at a 27% discount to where J.P. Morgan thinks it will be before this year ends. Now I want to show you why the structural case for gold has not changed, and in fact has gotten stronger during this correction, because this is the part that most people miss when they are caught up in the noise of a price decline. The forces that drove gold from $2,600 to $5,589 in 12 months were not random. They were not speculative momentum. They were real, documented, measurable structural shifts in how the global financial system is organized and where major institutional capital is flowing. The first force is de-dollarization, and it is accelerating, not decelerating. China, India, Russia, and a growing coalition of emerging market nations have been systematically reducing their exposure to US dollar-denominated assets for 3 years. Central banks globally purchased more than 1,000 tons of gold in each of the last 3 years. That is roughly double the historical average of 400 to 500 tons per year. The World Gold Council documented the strongest quarterly gold demand on record in the third quarter of 2025. These are not retail investors chasing momentum. These are sovereign wealth funds, central banks, and institutional investors making multi-decade strategic asset allocation decisions. That buying does not stop because gold corrected 18%. If anything, it accelerates because they are now getting the same asset at a lower price. The second force is the fiscal reality of the United States government. The national debt is approaching $40 trillion. Interest payments alone are now consuming more than $1 trillion per year, larger than the entire military budget. The government is adding approximately $7 billion in new debt every single day. This is not a political statement, it is arithmetic. And the arithmetic points in one direction for the long-term value of the dollar. Every dollar printed to service that debt is a dollar that makes existing dollars worth slightly less. Gold does not get printed. Gold does not get debased. Gold cannot be created by a central bank decision on a Tuesday afternoon. That fundamental asymmetry between a currency that can be manufactured at will and a metal that has to be physically pulled from the ground is the deepest and most durable reason gold has preserved wealth across every civilization in recorded human history, and it is more relevant today than it has been in decades. The third force is geopolitical fragmentation, and it is not resolving. The Strait of Hormuz situation is not a temporary disruption. The Iran nuclear standoff has no obvious near-term resolution. The U.S. naval blockade is in place. Energy supply disruptions are creating embedded structural inflation that central banks cannot easily respond to without triggering recessions. In this environment, the traditional safe haven logic for gold does not disappear, it intensifies. The correction we just saw was driven by short-term inflation fears, causing rate expectations to shift. That is a temporary repricing of timing. It is not a structural change in why gold exists in a portfolio. Here is the number I want you to focus on right now, because it cuts through everything else. Every major bull market in gold history has experienced significant corrections along the way without breaking the underlying trend. In the 1976 to 1980 cycle that produced roughly 500% cumulative returns, gold corrected by 30% or more, multiple times before continuing higher. In the 2001 to 2011 cycle that produced approximately 600% cumulative returns, corrections of 15 to 25% were routine, and every single one of them looked like the end of the people who did not understand the structural drivers. The current cycle began in 2022 and has produced approximately 200% returns so far, according to Van Eck analysis. The recent correction is only the second correction of 10% or more in this entire cycle. 2 corrections in 4 years. In the historical context of major gold bull markets, that is not a broken trend. That is a remarkably healthy one. The people selling gold right now at $4,600 are doing exactly what retail investors did in 2008, when gold corrected sharply during the financial crisis. They sold, and then they watched gold go from roughly $700 to over $1,900 in the following 3 years. The pattern repeats. The mistake repeats. The question is whether you are going to repeat it with them. Now let me give you the practical framework, because analysis without application is just entertainment. There are 3 things I look at when deciding whether a gold correction represents a buying opportunity or a genuine trend reversal. The first is institutional positioning. Are the big money managers and central banks changing their structural allocation to gold, or are they maintaining it? JP Morgan is maintaining a $6,300 year-end target. Deutsche Bank is maintaining $6,000. Central banks purchased 755 tons in 2025 and are expected to maintain elevated buying through 2026. Institutional conviction has not changed. The second is the macro backdrop. Have the underlying forces that drove gold higher gone away? De-dollarization is accelerating. The U.S. fiscal situation is deteriorating.